Welcome back here with Money, Money, Money. And this week we are discussing a couple of important updates that have come in through the tax world, whether it's your IT returns, Aadhaar or PAN, or of course a couple of clarifications that also came in from the CBDT. Well, the other aspect that everybody is talking about now is what happens when GST sets in. So, Harsh, I want to ask you this because we understand that the rate, most services and financial services, the rate that is being applied is 18%. How does that change my life with respect to my mutual fund investments and when I'm buying an insurance policy?
So, well, Surbhi, while we considered all the financial services and it was in the service tax regime, we are currently in the service tax regime, wherein the rate of tax is 15% on all the financial services. Now, look at it from a GST perspective, it has been increased to 18%. So invariably, let's talk about insurance first. So whatever insurance policies you had, which are pure risk-based policies, which are your term plan, your medical cover, all those you're paying 15% service tax will now become 18% GST. So your cost is going to go up by 300 basis points. Now with respects to your savings-based policy, so you have either a term plan or you also have endowment kind of policies. Now in those policies, you are paying a service tax of 3.75% in the first year, which was reduced in the second year to 1.87%.
Okay.
So you pay, that is the rate you're paying on your premium, total premium amount.
Okay.
Because the savings element is also a part of your endowment premiums.
So that was not being levied at a flat 15%. It was a much lower number.
Absolutely.
Okay.
Now this will also be increased because of the impact of GST at 18%. So now the first year, instead of paying 3.75, you're going to pay 4.5% as your GST.
Okay, and this is applicable to endowment policies specifically?
Any savings-based policies,
okay,
which do not have a segregation of the risk premium and investments. So like if you had a term policy is a pure risk premium that you're paying. So on that you will pay 18%. In your ULIP policies, on all the charges that are amortized in your policy, you will be paying tax at 18%. Okay. However, in policies which are combined with investments and risk cover, the tax that you were paying earlier, the service tax was 3.75% at the 15% calculations. Now that will increase to 4.5% in the first year. The second year, while you're paying today, you're paying 1.87%. The next year after GST, it will be 2.25%. So there is going to be a marginal increase in your tax outflow in both these kind of policies. Now, with respect to mutual funds, there is a cost that you're paying, the fund management charge. Is basically called total expense ratio, the TER. Now, there is going to be an impact on that as well. Because, as I said, it was a 15% earlier, now it's going to become 18%. So, the total expense that you will be paying on your fund management or on the portfolio that you have will go up marginally by about, say, 3 to 4 basis points. So there will be some impact on that as well.
3 to 4 basis points, but that does not sound too dramatic.
Most importantly, and only time will suggest, is because there is an input credit facility also available. Now earlier, say a fund house had certain expenses on which they were paying VAT. Now they couldn't take that as an input credit for the service tax.
Right.
Now with all the taxes coming together, and there is an input credit which the fund houses will be possibly able to take. So there is a great possibility that the actual increment will not be passed on to the investors.
Because the institutions start getting the input credit off the other taxes which they couldn't claim
Absolutely.
till now.
And with this anti-profiteering clause being very strongly advocated about and being enforced about, you cannot benefit out of any input credit that you're getting, which you were not getting earlier. So there's a great possibility that the fund houses or the insurance companies may not actually pass on the cost to you and might take it over with them because they're also getting an input credit which otherwise they did not get earlier.
Archit, your thoughts on how GST might impact our savings and investments particularly?
So basically, I think strong concurrence on the anti-profiteering aspect, right? Like basically, I strongly think like that 3% spread may get covered just by the fact that there may be enough input credit to claim, and I think like everybody wants to not have an inflationary effect of GST on the economy. So like fingers crossed, but I think should not have a big impact on the retail investor.
Okay, fair enough. Well, on that note, let's also address some viewer queries that we've been getting. I believe we do have Mr. Roopchand with us on the line. Hi, Mr. Roopchand, can you hear me?
My status as an NRF, I was abroad for almost 30 years and I returned home on 1st February 2014 to India. So the first for FY 2014-15 and FY 2015-16, I filed my ITR under the status of RNOR. And all my interest on FCNR US dollar fixed deposits were shown under exempt income.
Sure.
So now this is the third year now for FY 2016-17. So should I show my status this year as resident instead of RNOR as in the past?
Okay.
And should I have to pay tax on the FCNR interest with effect from FY 2016-17?
Harsh, now that he's come back and he is, pretty much staying in India, does he have to change his status as resident? And then what about those FCNR deposits? Basically, there's a tax liability there, right?
Absolutely. So, if you have come back on 1st February 2014, and after which your residential status, if it's no more resident but not ordinary resident, and you are a resident of India, in case your residential status has changed to that, then you must and you have to, in fact, file your returns as a resident. Now, FCNR deposits, the interest that you were earning while you were an NRI, there was no tax implication on that. It's tax exempt. But in case your residential status has changed, then of course there will be a tax incidence on that. So it is in your interest that you file your tax returns with the exact residential status that you enjoyed today, and pay all the taxes that are liable to in that context.
And could this be retrospective as well?
Yeah.
There could be a sort of a query on the FCNR deposits of the last 2 years as well?
So in case your residential status has changed in financial year 14-15 itself, and you have filed your returns showing as NRI, then and you've got certain tax benefits as a status of NRI, and that was not a true declaration. In that case, there will be a tax implication from the year financial year 14-15 itself.
Okay, well, actually, we have run out of time, but thank you so much, Archit and Harsh, for joining in and taking us through, of course, some of these important aspects of changing taxation. That's where we'll take your leave. We'll see you again next week.